that decision like to actually give up your 7? No one talks about that. And I think I'm not like it's good or bad. I'm just saying, what
Yep.
was it like for you?
I think that's a great question. And the honest answer, it was scary, right? So when I gave up my 7, I already had it for almost a quarter century, right? And like you, like everyone else that had the 7, it wasn't like some easy test. Like it was a pretty good amount of
Yeah, I
effort
don't
to
think
pass
any of
that
us would
test.
pass it if we had to take it again.
Oh my God, now without any
Yeah.
prep?
Or we
Absolutely
might
not.
just barely pass.
Yeah. Well, actually, I passed with a good amount. People gave me a hard time. I got a 93 and they said I wasted
Oh,
time. I should have been calling more is what they said. And they were
yeah,
perhaps
right.
right.
Yeah.
Welcome to Advisor Talk with Frank LaRosa, brought to you by Elite Consulting Partners. It's the only podcast offering unfiltered guidance and the direct advice for all things concerning financial advisors, RIAs, and the practitioners in the wealth management business. And now, welcome to the show.
Hey, everybody. Welcome to Advisor Talk with Frank LaRosa. I am Frank LaRosa, your host, and today we are going to talk about going RIA or not going RIA with Chuck Failla, who is the CEO and founder of Sovereign Financial, also a fellow podcaster who launched Go RIA podcast, which is really good if you want to learn about all the good, bad, and the ugly about going RIA. It's the place to go. So, Chuck, welcome to the show. It's been a while since we were trying to coordinate this.
Absolutely, Frank. I appreciate it. I've been looking forward to this for some time. I'm a big fan of your show, and it's a real pleasure to be on it.
Awesome, great. So, let's jump right into this because for my audience, they know I can be somewhat opinionated, and I don't always sort of I'll call it company line in terms of like everybody needs to go to be an RIA, right? I don't believe that's the case. Or you can, be an RIA with $50 million. I don't necessarily think that's a good idea either. My opinion is it's got to be close to $1 billion or more to really be effective because I think that there are other solutions, which we'll get into, like with your offering, which isn't really the purpose of necessarily the majority of this call. It's just a great solution that you provide. But it's really why I sort of get excited about these things because I do think there are alternative options than someone sort of like eating the elephant all at once. Right,
Yeah.
by going RIA. So, for the audience, maybe just give a little bit of background and color on you and sort of your background and your firm and what you do and maybe some of the things you spend. You spend a lot of time in the air, traveling. Many people may or may not recognize you at a lot of conferences, industry conferences. So maybe just talk a little about that, and then let's just get into the meat of this: why someone should and shouldn't go RIA and what they should be thinking about with both of those solutions.
Yeah, that sounds good. And that's a great way to frame our talk for today. So I'll give you just a very brief overview of where I came from, what got me to this place. So I've been an advisor for 30 years. Started off way back when, in the mid 90s, as a cold call cowboy in New York City, like literally smiling and dialing 400 dials a day, selling individual stocks. So I mean, when I say I've seen it all, I could say that's a pretty accurate statement. I did that for about 3 years as a cold caller, selling stocks, had a lot of fun. It was essentially like working in a frat house. So good when you're a young man, but it's not really
Yeah.
an older man's sport, that's for sure. Then I went on to Raymond James, right? I joined their independent broker dealer channel, have absolutely nothing but great things to say about it. Huge fan of Raymond James, and they did very well by me for about 20 years as I was running my own independent branch. Then about 6 years ago, I really reflected on the idea of going RIA. I really saw that I was essentially running as an RIA within the Raymond James system and was butting up against some issues, mainly not even the higher payout that I was striving for, although that came, of course. I wanted more flexibility to do work in the media. And the most flexibility you're going to have is having your own firm because you're setting the ground rules. So I set out and formed Sovereign Financial Group as an SEC RIA. That was about 6 years ago. And fast forward to where we are today, and worth noting too, when I launched Sovereign, I fully had a lifestyle practice, right? It was me, a junior partner, and just over 100 million. Like we just got into that SEC range, which I would advise anyone to wait for that at least.
Yeah.
But within 5 years, in fact,
We'll
that's
get into
exactly
that
what I'm getting at.
little
Yeah.
caveat there in a minute.
Yeah. So, the first year we set out to build a platform for advisors to plug in with. Basically, we could do all the work, they could do all the client relationship. The first year we started, built our tech stack, completely messed it up, had the wrong technology. It wasn't playing well with each other. Year 2, which brings us to about 5 years ago, we got the right tech stack. Then year 3, right, which brings us to about 3 years ago, we really wanted to get our name out there. And that's when I formed GoRIA.com. Then a year into that, I partnered with Investment News. That was the hockey stick moment. And now it's Go RIA, fueled by Investment News. And what our goal is to educate tens of thousands of advisors about the benefits of the RIA space, why you should go, how you can go. But then also, and I like to be very transparent about this, our expectation is as we're educating at this point now tens of thousands of advisors, we would expect that dozens of those advisors would find Sovereign to be a good fit for them. And that's exactly what happened. So within less than a handful of years, I went from literally just a $100 million lifestyle practice, which there's thousands of us out there. Now we have over $1 billion, 20 advisors, and a legitimate platform that's literally purpose-built for a certain advisor. And that certain advisor is the advisor that literally uses e-money or Right Capital. Like, we're very niche. And that's what we've done. And it's been a lot of fun doing it. And of course, very satisfying to see that growth, but then also helping advisors make that transition to the RIA space, which I also get a lot of satisfaction out of.
Awesome. So that's really interesting. So in a way, you're like a player coach, right? Because do you still work with clients?
My call right before this was with one of my clients. Yeah,
Okay.
I run a book of business. And so what I'd like to say is we are not only a firm that was built by and for advisors, but it was built by and run by a financial advisor for advisors. So I'm very, very much in the trenches, and we build our systems to make me happy, to make my life easier. And if you're an advisor that loves e-money or Right Capital like I do, our systems are really, really made for that advisor.
Okay. So let's circle back with that in a little bit. Let's dive right into your last comment where we both chuckled about going over the $100 million mark and becoming effectively going from a state-registered RIA to an SEC-registered RIA.
Yeah.
For those that maybe don't understand what that means, give us the third grader version of why that's the case and why you do or don't want to do that, depending on where you're at in your AUM levels. Yeah.
So as you're putting together your decision tree, and I'm a big fan of those, on whether you should go RIA, when you should go RIA, I would say the one line of demarcation that you could easily put into that decision tree is $100 million. Here's the reason for that. Under $100 million, you're subject to state regulators. That's a hassle, especially if you're working in more than one state, right? If you're working in multiple states, now you're subject to multiple different state regulators. The only thing worse than one regulator is 5 regulators, right? Or 2 regulators. You don't want that. So the way that you get one singular regulator, meaning the SEC, is you have to have over $100 million in AUM. Now, having said that, and I've said this a lot publicly, if you are someone that really wants your own firm, economically, at least $100 million is what you want. But that said, if you're chomping at the bit to have your own firm, and I've said this a lot publicly, you can have $5 million of AUM, a laptop and a dream, and just have at it. And you could definitely do it. Economically, it's not going to make the most sense. As long as you're aware of that, you could definitely do that. And if it's important to you, you should. But at least $100 million, that's probably the first realistic time you should think about it. I would say, Frank, to your point, somewhere, in my opinion, between 500 million and $1 billion is where it makes a lot of economic sense to have your own. But again, I say this all the time, have a, 5 billion under management. If you really want to do that, go ahead and do it. Economically, you are not going to do as well until you build up to at least 100 or 200, 300 million. But if you want to do that, if you have a burning desire to do that, then you should. But at least 100 million is the first point where I start thinking it makes some sense.
And so, I've talked to some smaller RIAs, and they literally tell me that they are, I'm not really bringing on any new clients because I don't want to go over $100 million. I don't want to be SEC registered. And I don't it doesn't register with me when people say they don't want to grow. I don't really know how to respond to that. My sort of brain goes on tilt a little bit. So why would someone not want to move up to that, over $100 million mark? What's their logic? I mean, they say, well, I don't want to deal with the SEC, but you're still dealing with a state regulator.
Yeah. I think, frankly, it's easier to deal with the SEC than the state regulators, right? And, if we're doing a little inside baseball here, state regulators, I would argue, have a little more time on their hands, frankly, and you're going to see them perhaps even more often, right? So I find it easier to be SEC registered, especially if you're going to be working in multiple states. If you're working in multiple states, it's, in my opinion, just an absolute no-brainer that you would prefer SEC. If you're not big enough, you're not big enough, but you would certainly prefer, again, that one consolidated regulatory body that you have to answer to, as opposed to 2 or 3 or 5. So I don't quite get that either. And like when someone says, why would I want to grow? My response is, I don't understand that question, right? Like, why? That doesn't make sense to me.
Is that a trick question?
Is that a trick question? Am I missing something? But I also understand lifestyle practices, but it still is easier to have over 100 million for a lot of reasons. You'll have the scale for better support, better technology, and that will also, if you're looking to have an easy lifestyle, that's going to help you do that too. But I think really that $100 million mark is that first hurdle to start really thinking about going truly on your own.
So we switch gears for a second now. Well, let me go back. Have you ever had any conversations with somebody, and let's say plus $100 million, and you've just said to them, hey, listen, I don't think going RIA is the right strategy for you. Tell me about any conversations you've had there, or better yet, who are those people that you don't think should go down that road, and they'd be better off staying with an independent broker-dealer?
Yep. So I would say for me, the way I advise people is if you have more than 20% of your business in commission-based business, and you're looking to maintain that for a long period of time, then probably the IBD route is good for you, right? The bigger question is, do you want to have any broker-dealer business or commission business? And I'm not looking to make this a philosophical thing, or certainly not a judgmental thing, right? Because I know a lot of folks in the RIA space can start getting that holier than thou attitude, right? Which I don't think is constructive. And I get that. And it's prevalent. But for me, I dropped my 7. Let's look at it from an economic perspective. Dropping your 7 means you don't have to answer to a broker-dealer. Not answering to a broker-dealer means you have a lot more latitude with what you could do, which is not to say it's the Wild West. But if you're looking to take advantage of podcasts, like Frank, you and I do, or social media, or any work in the media for that matter. My gosh, I do so much work in the media right now. It would have been absolutely impossible, let alone Raymond James, any broker-dealer. It would have been impossible for me to have the level of work that I currently do in the media, social or print or otherwise, if I was with a broker-dealer, right? And this is not a slant against them or a slight against them. It's just how they're constructed, right? When you have your own firm, you have a lot more say on what you're going to do and how you do things, right? So our compliance team is in-house. So if I need to do something, we stay compliant. But if it's your compliance officer, let me tell you something, things happen pretty quickly, right? When the compliance is on the payroll, which is not to say they're going to let you do something wrong, because the way we structure it is, rule number 1 is keep the firm safe. Rule number 2 is don't stop us from doing business if it doesn't contradict rule number 1. So let's find a yes as opposed to defaulting to no. And if I could just say one other thing on this, and I really believe this is how it is. When you're dealing with a large entity, it could be a large RIA too. We're starting to see this as well. But let's say you're with a larger broker-dealer, larger independent broker-dealer. That compliance officer who's approving your media appearance or your podcast or your presentation, guess what? They get paid the same if they say yes or if they say no. Their compensation doesn't change, right? So there's a strong argument to say they are incentivized to CYA, right, cover their butt and just say no, as opposed to, again, not letting the firm go off the rails, but perhaps let's be proactive, let's be creative, and how could we get to a yes as opposed to a no? And I think that's a huge advantage in the RIA space.
Yeah, it's funny. I never looked at compliance that way in terms of there's no real upside for them to say yes to something that's on the edge, right?
Right.
Because if it comes back negatively, they could lose their job or whatever, get in trouble or whatever. Versus just saying no doesn't mean anything to them.
Right.
What I wrote something down. What was it like? You said when you gave up your 7, right? We've been in the business about the same time, back in the early 90s. Sounds like cold calling, and when there was no such thing as the internet.
Clients would call for quotes.
Right. Actually call. Right. Yeah. There was no email system. Right. So it was interesting. But what was it emotionally like? This is not like a therapy session, but what was that decision like to actually give up your 7? No one talks about that. And I think I'm not like it's good or bad. I'm just saying, what was it like for you?
I think that's a great question. And the honest answer, it was scary, right? So when I gave up my 7, I already had it for almost a quarter century, right? And like you, like everyone else that had the 7, it wasn't like some easy test. Like, it was a pretty good amount of effort.
Yeah, I don't think any of us would pass it if we had to take it again.
Oh my God, now without any prep? Absolutely
we might
not.
Just barely pass.
Yeah. Well, actually, I passed with a good amount. People gave me a hard time. I got a 93, and they said I wasted time. I should have been calling more, is what they said, and they were perhaps right.
Yeah.
But man, I could not answer. I don't think I could answer one question on MSR. What is it? I can't even think of the acronym.
MSRB. Yeah. MSRB. Yeah.
Why the hell are we even learning that? But to your point, it was scary, right? So I had it for 25 years, and it was something not easy to get necessarily. And I was like, am I doing the right thing by getting rid of this? And I will say this. If it wasn't for the fact that I knew that I can get it back right away, right? Within, what do you have, like 2 years? And I think it's even extended now.
I think I actually extended it to, I think up to 5 years now.
Yeah.
I think if
it wasn't for that,
like a licensing fee or something.
Yeah, I recall something like that too. So now you have 2 years or more to get it back. And when I dropped mine, I knew I had a solid 2 years. So if it wasn't for that, I don't know if I would have even done it. Right? Because I was nervous about it. I'm not going to lie. Like, I try to be very straightforward and authentic about these things. I was nervous dropping it. And if it wasn't for the fact that I knew I can get it back within 2 years, I'm not sure if I would have. But knowing that I could have, let me tell you something. It didn't take more than 2 or 3 or 4 months. I was like, man, I didn't need this thing at all. And this was 5 or 6 years ago.
Right.
Now, and I put this challenge out there. I said, tell me one thing you need to have a Series 7 for that you can't do otherwise. Like, what is that? Alternative investments? No, fee-based. Annuities? Fee-based. There is nothing. And I challenge the audience, find me on LinkedIn. Tell me that one thing that you need a 7 for. And the answer is nothing at this point. And that was not absolutely the case 5 or 6 years ago. There were still, especially the alternative investments, there were still very few. But now, every alt, look at Case, look at iCapital, any alt you want, fee-based. Any annuity construct you want, fee-based. There's just not a reason for it. And if you are like an insurance person, you don't need a Series 7 for most insurance, even, right? So I don't really see the need for it anymore. And it comes with an additional layer of compliance burden. And for me, why bother with that, right? And
so, and then if you're building an RIA, and I think this is what people don't understand. Like, so you can have like people use the term hybrid. Oh, I want to be a hybrid RIA. I'm like, oh my God. Like, I think they just throw that around because it sounds cool to say that until they sort of get into it. But by going down that route and keeping your broker-dealer license, what they fail to understand, this is where that 20% comes in. You might keep 20% of your broker-dealer business, but the friendly VD that you go to is going to charge you an oversight fee on your advisory assets, which could be more than the revenue you're getting from the 20% of your brokerage business. Is that what you see?
Absolutely. Plus, also, you have to submit all of your things to them. There's no such thing as, well, this is an RIA marketing piece. It's a marketing piece or it's not, right? And you have to submit it to that broker-dealer for 20% of that business. Makes no sense. And, I think you guys covered this in one of your podcasts before, but there's so many great options. And this is not necessarily to give a plug, but, folks like DPL, they have this ability now where you could transfer over your block of annuity business. Mm-hmm. And I thought this was genius when David Lau did this. They will collect the, air quote commission, using their BD license,
Right.
and then they will take a haircut, because they should, and then pay you, air quote, an advisory fee.
Right.
Brilliant,
Brilliant.
right? So you don't even have to worry about losing your trails. Again, I put this out to the audience. Find me on LinkedIn. Tell me something you need a Series 7 for. I don't believe there's a thing.
Yeah. And when you make a comment here, because I also see this as a little bit of lack of education, trails from mutual funds to the audience are not considered advisory business, right? They're not considered fee business. They're recurring fee business, but they are still broker-dealer business.
Yep.
Because I'll talk to somebody and they're like, well, I'm 80% advisory. I'm like, okay, and they give me the breakdown of their assets. I'm like, dude, you're like 50% advisory. What are you talking about?
Exactly.
I'm like, all these Al share annuities and the mutual funds, that's all brokerage business. Yeah, but it's recurring. I'm like, it's not the same thing.
Right.
So
it goes
understand
right
the
through
difference.
that Series 7.
Yeah, right. Understand the difference between advisory and recurring. So,
Yep.
I'm just in the interest of time because I want to cover two topics. One,
Sure.
I'd like to cover. I think this is an interesting topic in terms of thinking twice about before making the jump to become an RIA or not becoming an RIA. State versus SEC is sort of something you need to think about. But there's something else happening in the space, and you sort of use this term breakaways, right? But I've been saying for the last couple of years that I think there's going to be a flood of RIAs that went RIA that were maybe ahead of the curve, right, years ago, thought it was a great idea, was probably, the SEC was probably easier to deal with at that time than they are today. And now it's just not fun anymore, right?
Mm-hmm.
And they are rolling up, and no particular size, just they're rolling up, or I think they're going to continue to roll up into larger RIAs. Can you maybe just peel the onion back on why you think that's happening?
Yeah, I think you hit it right on the head. I think a lot of folks are starting up RIAs and thinking it's going to be a little bit easier than it really is, because it's not. It's doable, absolutely doable. There's a ton of resources. It's doable. But it's not like I'm going to run my book of business and spend a few hours a week running the firm, right? I can't even say that with a straight face, because I see what we do, and we have like a full-on staff. We have a full-time ops, full-time trader, full-time compliance, and I'm still helping to run the firm. So there's work to it. Doesn't mean you shouldn't do it, but like with anything, and I tell this to clients, again, I work as a financial advisor every single day, right? Not just the CEO of Sovereign. And what I tell clients is what I would tell the advisor, which is there is no right or wrong decision. There is an informed or uninformed decision, right? So if you have, relatively low AUM and you want to start your RIA, if that's what you want to do, you should, but be informed of what it's going to cost you. It's probably going to cost you more than if you tuck in, most likely. If you're cool with that, then it's the right decision for you. But to get back to your initial point, I think we are seeing a lot of these firms that started up, and maybe they did not have the scale to bring on a full-time ops, full-time trader, full-time compliance. And now they're wearing, 3, 4 different hats, like support, 5 hats, whatever it is. And they're like, this is not working. And now those people have a couple of different options. They can roll up into another larger firm, usually a larger firm, or there's something, and I know we've kind of talked about this offline, that we think will be kind of interesting, which we call Sovereign as a Service, which is essentially a full-on boutique of services, but you still have your own ADV. I think that's going to be a very interesting thing. And that's a space that I think we're going to see a lot of growth in. And then the other part is just the opposite, right? That individual advisor that left, let's say, one of the big banks, like one of the big wirehouses, and they went to one of the mega RIAs. And then they get there, they're like, wow, this kind of feels a lot like the firm I just left, right? There's not much change. Like, I can't do this, I can't do that. I thought I was in the RIA space. But make no mistake, that's not your RIA. That's someone else's RIA, right? So they're setting the ground rules. And I'm not saying that's bad,
it's their CYA, not yours.
That's exactly right. And so it's not, again, a right or wrong decision, but be informed. So what I think we are going to see a lot of soon, because we have a lot of these people that left 3 or 4 years ago, maybe they took a check to go to the large RIA, the way that large wirehouses do. And now they're sitting there like, this is not feeling as independent as I thought. And that's where I think we're going to see, we're already starting to see this. We're actually doing a podcast next month on this, of a breakaway, someone that left a big firm, went to a big RIA, felt that this kind of feels like the big firm I just left, and now they want to break away again. And they're in the process of considering, as I like to put it, tuck or no tuck. Either they're going to tuck into another more boutique type of shop, or they're going to set up their own small RIA. So I think we'll see both of that.
So you mentioned this, so sovereign as a service. So can we get into, we got about 10, 15 minutes left here.
Yeah.
Part of what we do here really well, I think, and we have someone coming to us and say, I want to do this RIA thing. It's usually how the conversation starts. I'm like, well, first of all, if that's how you're entering, you probably don't have enough information, because this RIA thing is not the way to go, right? So, we spend time educating them. And part of the reason, and there are a lot of firms out there, and so, that can do this type of thing.
Sure.
But we always try to advise, like, it's not a all or nothing to these firms, right? I talked to a guy from a wirehouse, and he's like, I want to do this RIA thing. I'm like, you don't have to go, like, eat the elephant all at once. The better solution, in my opinion, is to affiliate with an RIA for a period. This is to someone that's coming out of the W-2 wire retail space, right? Affiliate with an RIA, essentially learn how to walk, crawl, then walk, right? Because you're not even a business owner when you're in a W-2 shop, right? You're just a practitioner, so you still haven't even figured out how to use QuickBooks.
Yes.
Right? Let's crawl first. But this whole idea of an incubation period, right, where you work with, whether it's your firm or another firm, and they help you incubate your business and they incubate the RIA, and then if you want, you can then sort of lift out, operate your own RIA, and then use what's essentially your services, right, sovereign as a service, to then help you run the firm, right? So can you just go through that? Because I think it's really, I'm not going to say unique, but I think that you have a really good model, and I think that your pricing is really good. So maybe just in terms of education here, explain how your system works.
Sure, absolutely. So the way I like to explain it to folks is we have 3 doors you can come in through, right? Door number 1 is you tuck in under RADV and you brand as sovereign, right? That's door number 1. That's what most advisors do, at least at first. Door number 2, you tuck into RADV and you brand as your own self, right? Sound Point Wealth Management or whatever you want to call yourselves, right? But you're still under RADV. Door number 3 is you tuck in with us, you learn the systems, you get your sea legs, and then, as I like to say, we're not going to let you leave. We are going to help you leave. And we will stand you up with your own RIA, your own ADV. You'll use the same compliance methodology and systems that we've been always using, the same trading, the same everything. And here's the difference. Let's say you came in initially under door number 2, right? Tucking in under RADV, but branding as yourself. So your website's going to be, whatever I said, Sound Point. I don't know where I came up with that name, but Sound Point Wealth Management sounds like a firm. Sounds like a good one. Sound Point. I'm not even sure what the hell Sound Point is, but Sound Point Wealth Management sounds good. But then on the bottom in small print, advisory services through Sovereign. So let's say you do that for 12, 18 months. You learn everything. You got your assets all transferred. Everything is cool. Now you want to make that final step and really have your own firm. Again, we're not going to let you. We're going to help you do that. So Friday, you leave the office, Sound Point Wealth Management, advisory services through Sovereign. Monday, you come back into the office and it's Sound Point Wealth Management, period, full stop. It is now your firm. And that, I think, is the way of the future for this. And I think we're going to be able to really help both sides of that spectrum, right? The advisor that's the breakaway, right? They went from a big wirehouse to a big RIA. They're like, I don't want this. I want my own firm, but I want some guidance, right? Supported independence, which is a term used a lot and for good reason. Or we have the other ones that started their own RIA, complete independence, but like, wow, this is a lot of work. Those are the 2 people that would be most suited for sovereign as a service. And we're pretty excited about that. And to your point, we do have very low pricing. And I always like to say this in the same paragraph as saying we have low pricing, right? If you buy wine the way I buy wine, and I know nothing about wine really, I go into a store, we're going to a dinner party. You're not going to buy the $15 bottle of wine because that's got to be, horrible.
Mm.
You're buying by price. So I like to explain why our price is so low, although our wine is fantastic. And it's simply this: we do not have this private equity overlord to tithe back to, right? We are 100% independent. In fact, right now I own 100% of the firm. By this time next year, I'm going to own less than 100% because we are having our next gen advisors, voluntarily, whoever wants to buy in can buy in. And also, very importantly, our next generation operators, right? Director of operations or director of trading, who are fortunately a lot younger than me, right? It doesn't work when you're giving equity to someone older than you.
Yeah, right.
And these are the people that are going to run the firm. And because we don't have to tithe back to our private equity overlord, we're able to do this at a very, very competitive price. And, I do my research. Our pricing is much, much lower than firms that do exactly what we do. But, 20, 30% of our profit doesn't have to go to some PE monster standing behind us.
Right.
We take that margin and translate that to a more competitive platform fee. And that's something we're real proud of. And it's actually right on our website. I think, and, keep me honest on this, I don't know of any other firm that has their economics to the penny on their public-facing website. And we do that because, number one, we believe in transparency, but frankly, number two, because we know our pricing is just hard to beat.
Yeah, I don't know of any firm that puts that stuff out on the website, and I think that that's a great solution, because I do agree with you that getting rid of the broker-dealer side and not having to deal with FINRA and all the things that go there, in this day and age, advisors, in order to separate themselves, have to be more progressive in terms of their branding, social media, online presence, and a lot of the broker-dealers, although they're catching up, they're just still behind, and the turnaround time to get stuff done is still somewhat difficult. So I do think that it's a great solution.
One other thing too.
Who do you?
Yeah.
So this way you don't get inundated with phone calls, which I guess that would be great, right?
Sure.
Who is not right for your platform?
That's a great question. So someone who has more than 20% of their book of business in commissions and doesn't want to change that and doesn't want to change it. But if you are looking to move, not overnight, but over the next few years over to pretty much fee-based, right? Some commissions on the side is fine, but really, if it's going to be more than 20% on an ongoing basis, we're not going to be the best fit for you. But probably the better way I can answer it is this. The advisor who is just the absolute best fit for us is not just a financial planning oriented advisor, but very, very, very specifically, we really built this firm for users of e-money and Right Capital, cash flow based financial planning systems, because part of our secret sauce is we have an in-house TAMP that we run at cost, 5 basis points, 10 basis points if you want portfolio group tax sensitive trading. That's ridiculously low. That's at cost. We do that as a value add. But what's really interesting, and this is something I would love to do a demo for any advisor that's interested, is once you do your 5-year cash flow report, which if you're an e-money user or Right Capital, which of course those two are kissing cousins, they're very identical. Once you update your cash flow assumptions, a couple of clicks of the button on our customized and tailored Salesforce, you're done. Right? Whatever needs to get done for support gets done, to trading gets done. And that's really where we shine. So again, where we're the best fit for is that financial planning oriented advisor that really uses and leans a lot into e-money and Right Capital. I would go on record, and I'm happy for someone to say otherwise, we are the best fit out there for that. We are literally purpose built for that. And why is that? Again, I built Sovereign to make my life easier. So if you like to run business the way I do, which is I want to do e-money, work with clients and literally nothing else, like not a thing, then you'll like what we've built. If you don't like that, then we might be a fit for you just from a pricing perspective, but you'll be leaving a lot of our value adds on the table, which would, it's fine, But where we really deliver maximum value to our advisors are the ones that use literally those two software programs.
Okay. What about, I'm going to ask this question even though we're running a little bit on time, but I think it's important. So we can go over a little bit as long as you have the time. We never really talked about this, but talking about simplicity, right? What is your opinion on multi-custody? Like, I think that. Well, I'll just leave it at that. What is your opinion on multi-custody, and I'll just see what your answer is.
Sure. In my opinion, there's two reasons for it. One, again, I like to be very authentic. For us as a tuck-in solution, multi-custody is better for us as a firm because if we have an advisor that is with or wants to be with RIA or with Schwab or with Interactive Brokers, those are our three custodians, it makes their life easier, and that makes it easier for us to incorporate them into our systems. That's the most popular reason, I think, why firms are multi-custodian, if we're being honest, and I am being. Now, the other reason is this. There's starting to become more and more a differentiation between custodians. It's no longer a real pure commodity. I would say 5 or certainly 10 years ago, it was really hard to see the difference between custodian A, B, or C, right? But now there is starting to have that difference. So having the ability to be multi-custodian is not only advantageous for me as an owner of a firm, but it's also now becoming more advantageous for the advisor. Well, I guess I could say there's three things. The third and final thing where multi-custodial does help is, let's say you choose, again, we have RIA, Interactive Brokers, and Schwab. We're agnostic. We don't care which one you use. Well, let's say you end up with RIA, but then you're talking to a prospective client there with Schwab, and they're like, yeah, I got my checking here. I want to keep it here. Bing, bang, boom, a change of authorization, letter of authorization, no ACAT. Now you're the advisor on that account. That's pretty cool too. So those are the main reasons why multi-custodial makes sense for us as a firm, but then also for the advisors.
And would you say that it's always still good? With that said, you're better off having the majority of your assets with one custodian versus spreading them all out?
I do think so. I think it's better to say which one is going to be the best fit for most of your clients and have that be your primary. But then if you want to do, for example, like more sophisticated option trading, it's kind of hard to beat Interactive Brokers, right? For certain things, it's hard to beat Schwab, and for certain things, it's hard to beat RIA. So it's nice to have the three of them, but you're going to know your book of business, and I'd be happy to give you some chapter and verse of where I think the pros and cons are all three, and then you choose which one you want to be your primary. But the nice thing about us is when you place your trades, you could send in your orders to us. We do trading centrally, and we don't care if you have one household that has 2 accounts at each one of the 3 custodians. We could still trade that through our Orion system, Eclipse. So we have no problem doing that. So we have the technology to make, even if the advisor wants to be multi-custodial, and we have some advisors that do that, from their perspective and their client's perspective, it's also quite seamless. Okay.
So that's a lot of information, and I really appreciate it. And to my audience, I appreciate you joining. Look, this space there's a lot of moving parts in this space. And I think that the most important thing that advisors need to do is get educated. And that means having conversations because you don't know what you don't know. So if an advisor hears this podcast, Chuck, and they want to reach out to you, right, and have a conversation, obviously they can call me and I can connect you, right?
Sure.
But what's the best way for them to reach you?
Yeah, I tell you what, they can either email me. I'm pretty easy to find, right? I'm on LinkedIn. I am by far the most famous Chuck Failla on LinkedIn. And by that, I'm the only Chuck Failla on LinkedIn. So I'm pretty easy to find on LinkedIn. And I'm very quick to respond if you want to just shoot me an instant message, or you'll find my contact information on there. But if you just go to LinkedIn, you can find me. If you Google my name, Chuck Failla, I'm like the first 4 pages. Again, for no other reason other than there's not a whole lot of Chuck Faillas in the world. So that's one thing nice about having a fairly uncommon name. And then, before we sign off, Frank, first I want to say thank you for having me. This has been great. But I would love to continue this conversation and perhaps have you on our podcast over at Go RIA and maybe go into this kind of role reverse, like how do you help advisors make that transition or think through that transition? So if that's cool with you, open invitation, would love to have you on.
That would be great. I would love to do that. This is a deep topic, this whole area, so we can do all sorts of podcasts, like doing one on comparing one custodian to another custodian, because there's LPL as a custodian and Fidelity as a custodian and Goldman, and why one over the other and who to pick based on the type of practice you have. So we can talk some more about this, but I would love to do that, and I appreciate your time. So Go RIA podcast, which is great. What's your so Sovereign Financial is your sovereignfinancial.com if they want to check out your website?
Yeah. So if you go to, it's actually sovereignadvisorsolutions.com. So just simply sovereignadvisorsolutions, plural.com.
Got it.
But again, if you just find me on LinkedIn, all of that is there. It's a little bit easier sometimes, or simply go to goria.com, which is a real simple one. And, whether you want to speak with me or not, check out goria.com. There's a lot of great content on there too. I've got a podcast that I do every 2 weeks. I've got a live stream that I do every week. And what's been really great is I've been doing these on location. So if you like conferences as much as I do, I cover the FPA conference, the CFP conference, the T3 conference, the Schwab conference, the Future Proof, all that stuff. So if you like conferences and want to get like a little tidbit of each one of those, there's an on-location section at Go RIA that we've been getting a lot of great feedback on.
Awesome. Well, I appreciate it very much. Hopefully the audience will go ahead and check you out. And I look forward to setting up our next podcast. Thanks a lot.
Sounds good. Frank, thank you very much. It's been a great time.
Yep. Thanks. Bye-bye.
Thanks for listening to Advisor Talk with Frank LaRosa. If you're looking for more advice or solutions on any topics relating to the financial services industry, or just want to subscribe to our podcast, head on over to eliteconsultingpartners.com/podcast.